Welcome to the Seller Strategy Series from Top Hat Business Group. Today we're digging into a critical decision point in any business sale: how the deal is structured. Specifically, we'll compare asset sales and stock sales and walk through how each impacts risk, taxes, and the overall transfer process. Whether you're just starting to plan or already entertaining buyers, understanding this will help you make better informed decisions. In an asset sale, the buyer is purchasing the individual components of your business, like equipment, inventory, customer lists, and goodwill, but not the business entity itself. The buyer forms a new legal entity and uses it to acquire the assets. This is the most common structure for small businesses, especially under $5 million in revenue. For example, a buyer purchasing a landscaping company might acquire the trucks, client list, website, and branding, but leave behind the seller's LLC, debts, or legal liabilities. This structure gives buyers more control and lowers their risk. From a seller's perspective, it may require reassigning contracts or transferring licenses, which can add complexity. A stock sale, on the other hand, involves selling your ownership interest in the entire legal entity. The business stays intact, same contracts, same licenses, same employees, but now under new ownership. This can be ideal in industries where licenses, certifications, or contracts are tied to the entity, like home healthcare or financial services. For instance, if a buyer wants to take over a firm with government contracts that can't easily be transferred, a stock sale might be the cleaner option. But there's a trade-off. The buyer takes on all liabilities, known and unknown, unless exclusions are negotiated. That's why stock sales are less common and usually involve more legal diligence. Stock sales are most common in corporations or businesses where important existing contracts are in place. No matter which structure you choose, remember this: the details are negotiable. In an asset sale, the seller typically retains things like cash and accounts receivable, while the buyer chooses which assets and liabilities to assume. In a stock sale, the buyer generally takes over everything, but exclusions and protections can be written into the agreement. If you're selling a business with hard-to-transfer contracts, like a school or a tech firm with long-term software licenses, a stock sale might actually reduce friction. We've also seen hybrid deals, for instance, selling the assets of a business while agreeing to transfer certain liabilities or leases. Your broker, legal, and financial advisors play a key role in crafting a structure that fits your business, your industry, and your goals. Equally important are the tax consequences. In an asset sale, the sale price is allocated across different asset classes, like equipment, inventory, and goodwill, each taxed differently. This can mean a mix of ordinary income and capital gains for the seller. Meanwhile, the buyer may benefit from a step-up in asset basis, allowing future depreciation. In a stock sale, the seller is typically taxed at capital gains rates on the entire transaction, often more favorable. But the buyer loses out on that depreciation benefit, which can make them less inclined toward a stock sale. So why does this matter? We once worked with a seller who accepted a slightly lower offer for a stock sale because the tax savings more than made up the difference. The best deal isn't always the highest price, it's the one that works best for both sides after taxes. To recap, asset sales are more common in small business deals. They let buyers choose what they're taking on, offer flexibility, and often come with better tax treatment for the buyer. Stock sales keep everything intact and are helpful when continuity is key. They come with more risk for the buyer, but are common in larger corporations or when important contracts must be retained. And don't forget the tax angle. Asset sales can result in a mix of ordinary income and capital gains taxes, a negative for the seller, but often include a step-up in asset basis, which buyers prefer. Regardless of the sale type, nearly every element of the purchase agreement is negotiable. Work with your broker and advisors to weigh the practical, legal, and financial impacts of each option. The right structure can make a big difference in what you walk away with. If you're thinking about selling your business, understanding deal structure early can give you a strategic edge. For expert guidance, visit Top Hat Business Group or reach out directly. And don't forget to subscribe for more real-world insights from the Seller Strategy Series.